Welcome to the TValue online video training series. We're going to talk about handling a troubled debt restructuring, TDR, and doing the interest rate reduction to determine what the allowance for loan loss is. With TValue, our methodology is to create two schedules. The first schedule will be our TDR schedule, and that's to replicate the loan modification. And we do that so we can determine what the expected future cash flow is. Once we have the expected future cash flows, we're going to create our second schedule, which will be our NPV schedule or net present value schedule. And that's to do the discounting. And once we have those two numbers, we'll be able to determine what our allowance for loan loss is. So let's go ahead and look at our assumptions. Let's assume we have a loan modification of $250,000. The original interest rate was 5%. That's the only number we used from the original agreement. The loan modification rate will be 3.5%, and we're going to go back to our original term of 30 years to manage our cash flow. And now we want to determine what is our future cash flow. So let's go ahead and jump into TValue Online. So here we have our label. This is how we're going to save the file. We're going to call it ABC Company, whatever your naming convention is, -TDR. We have our nominal rate of 3.5%, which is our loan modification rate. And we're going to go ahead and put our loan in. We'll have a loan of $250,000. We put $250K. And we'll go to line 2, and we'll put U for unknown. And we're going to put 360 for our number, and we'll go ahead and calculate, and our future cash flows are 1122. So this is our TDR schedule. We're going to go ahead and save this, and this will be TDR. Go ahead and save it. And now we're going to create our net present value calculation. So we're going to go ahead and use the same numbers. We're going to go ahead and change the nominal rate to 5%. And we're going to go ahead and put U for unknown here. So what we're going to do is use the future cash flows, 1122. And we're also going to change the name. We're going to change this to NPV for net present value. So now we have two schedules. Whenever you're doing the net present value schedule, you're always going to change two numbers. One is going back to the original contractual interest rate and always putting U for unknown. If you're getting a little more creative in the deal structuring and you have an interest-only payment, it'll say interest only here, and you have to normalize that. You go to special series and make it a regular payment, put a hard dollar in there. And if you're doing any rate changes in your loan modification, you want to delete the rate changes. So once you get to this point for the net present value, you only have your cash flows. We go over here now and we hit calculate, and our net present value at 5% of those future cash flows is $209,000. And that's pretty much it. We can go now to our summary. And we'll see here is we have our loan modification or TDR of 250. We have our net present value of 209. So our allowance for loan loss is 40,878. And once we have that number, we make our journal entry, and then we can start doing our accretion calculation. And as that amount is paid down, we get to reduce that. So if you have any questions, need any help, always feel free to reach out to us at 800-426-4741, or you can email us at info@timevalue.com. Thanks for listening.